Hello, this is Bob Steele. In this lecture, we will take a look at Chapter 13, which is going to be accounting for corporations. So we'll start off with the characteristics of a corporation. So a corporation is still a relatively new idea, and it's basically allowed us to increase the form of business in many areas. The characteristics that allow us to do this is that an entity created by law. So we're going to say a corporation is a separate entity, and it's going to have certain rights that we generally think of as rights to an individual, such as the right to own property. The corporation, rather than the individual, is basically owning property. It has a life basically of its own, meaning it's separate from an existence, separate from the owners. So we'll have the owners, and then the corporation will have a separate existence, kind of like a separate legal entity, which again, before the corporation, we're basically individual kind of rights. So the individual has the right to be a separate legal entity and therefore be responsible for owning assets and liabilities. The corporation has rights and privileges. So once again, we're given the corporation certain rights and privileges that prior to that were considered to be just individual rights. That idea has allowed us to grow in businesses. So we have the ownership can be privately held or publicly held. What that means is many people think it's really complicated to become a corporation. There are a lot of paperwork that has to be involved in a corporation. Corporations have to file separate tax returns and whatnot, but to become a corporation is not actually that difficult to form the corporation. And if you wanted to make a private corporation, it's possible to do that and not be publicly traded. The main reason for smaller businesses to do that is oftentimes for liability protection reasons. And or we can be publicly traded, and in a publicly traded company, that means the stocks are going to be traded on the public stock exchange and will be traded to the public in that case. And so, the two reasons to basically incorporate it, one is often for liability issues, and the other is often for capital generation. It's a way corporations can often generate capital through the issuance of the stock. So advantages. So the corporation is a separate legal entity. That is an advantage in many ways, in that it provides kind of that corporate liability shield. In some ways, it allows the corporation to be responsible for if the corporation got sued or something like that, and the owners of the corporation then will have less personal responsibility or liability on their personal assets, and anybody can go after the corporate assets. It's a limited liability of stockholders. So because of that separate legal entity, that's basically what causes, oftentimes, for the most part, the stockholders to have less liability in that individuals can't go after their personal assets as easily in a corporation. It's transferable of ownership. The stocks that we're going to talk about, a common stock is basically, you can kind of think of it like a poker chip in that they're all the same. So if we talk about a common stock, we can have more than one common stock, but the common stock itself is the same as every other common stock. That's what makes it so easy to trade. That's what makes it so easy to value, and that's one of the major characteristics that has been allowed us to transfer stocks and trade corporations more easily and generate capital in that way. Continuous life, so the life is not tied to the owners in this case. So if the owners pass away or whatever, they could issue the stock to someone else, and the stock has a life separate because it's a separate legal entity from the owners of the stocks. So lack of mutual agency for stockholders. The stockholders are going to elect the board of directors. They are going to be responsible for electing management and assigning management, and the management's responsible for the allocation, basically acting as the agents of the corporation. So remember, what an agent does is basically make decisions in terms of the allocation of resources in this case, or the acquisition of debt on behalf of someone else. That someone else not being necessarily a person in this case, that someone else being basically the corporation. So all employees, especially the executives, are acting as agents of the corporations, doing what's hopefully best for the organization. And in a partnership, remember, we had a pooling of assets, and the partners were acting as agents of each other's property. So it's a slightly different dynamic in the corporation. Ease of capital accumulation. So one of the major characteristics of a corporation is that we can issue stock, and by issuing stock, we can receive, of course, money for that in exchange for value in the company. That allows us to generate capital, which we can then invest in the company. So disadvantages, there's government regulation. So the corporation is the most highly regulated, which of course leads to the most paperwork and whatnot in processing the corporation. So it's going to cost more in that case many times. And corporate taxation. So there's more taxes oftentimes in a larger corporation. And one of the major issues is that oftentimes corporations will be taxed twice on their income, meaning the corporation itself will have to record net income, pay taxes on it at a fairly high top rate compared to other countries at this time. And then once they distribute the money, notice we used to call it a draw to a sole proprietor or a partnership, and it wasn't taxable. The distribution's not taxable when it's a sole proprietor or corporate or partnership, but when it's a corporation, it's called a dividend, and dividends are taxable income. So that means that the income is being taxed on the corporate side, and it's being taxed when we give it to the stockholders. And that is one of the major reasons that other entities came up for smaller corporations, such as the LLC, the S corporations, which act like a flow-through entity and kind of avoid that double taxation problem. So corporate organization management. So this is the structure of the corporation. Remember, who owns the corporations? Stockholders. But stockholders, similarly to citizens of a country who elect a president, are not the ones that make the day-to-day decisions. They elect someone to make the decisions, so they're removed from the decision-making process, even though they're the owners of the company. Similarly to the citizens being the kind of the owners of the country, but one step removed from, or a few steps removed from the decision-making process. So the stockholders elect the board of directors. The board of directors then hires basically the management, president, vice president, officers, CEOs, whatnot. Those are the people that run the company. So for the most part, these are the people that will run but if they do a bad job, of course, then the board of directors will remove them, and if the board of directors is run by the stockholders. So that's the structure and of the corporation. And then of course the employees will be responsible to the executives. So rights of the stockholder. So the stockholder can vote at a stockholder meeting or register proxy. So what that means is, if they meet once a year, the stockholders are going to get together, they're going to vote. The major voting decisions are going to be on who's going to be the board of directors. They have the right to sell stocks, so they can buy and sell their stocks as they choose. They can have the right to purchase additional shares. And oftentimes when that takes place is when a stock they're considering issuing new shares. What happens is if they print new shares out, that dilutes the stock that is already in the market. So they give the current stockholders the opportunity to buy the new stock in order to keep the relative even shares that they have. Therefore, they have the same amount of voting rights. So if I own 10% of the stocks and the company issues more stocks out there, if they didn't allow me to purchase it first, then they would be diluting my 10%, would be going down. And so that's the idea of that. And then receive dividends. So if the company, when a company earns income, then they need to sometime either invest that income back in the company to grow the value of the company, or they need to give that money to the owners. In a sole proprietor partnership, we called it a draw or a withdrawal. In a corporation, it's called a dividend. So if the company gives out dividends, every shareholder is entitled to the same amount of dividends that are declared. So share equally in asset remaining after the creditors are paid in liquidation. So if the company went out of business, then we'd have to pay the creditors and whatnot. And then once again, the shareholders get even distribution over the excess in the liquidation process. So notice every share is kind of like a poker chip in that it's the same. So they all have the same rights and they should have the same allocation. And that is what makes it so easy for us to buy and sell stocks and therefore create capital and create value by the ease of trade of a corporation, which is a lot easier when we're able to standardize these things. So here's basically an example of a stock certificate. Each unit of ownership is called a stock share. A stock certificate serves as proof that the stockholder has purchased value. This is a stock certificate for the Green Bay Packers. And notice that these days, a lot of times the stock certificates are going to be electronic. So we might not have the paper stock certificate, but You know, the idea is the same as it's a representation. And the if we were going to represent the stock on the balance sheet, we would have something that would look like this. We have a common stock. It has a par value of 0.01. Now the par value, what that means is it's an arbitrary number that we're putting it out there so that we can standardize the unit. Doesn't mean that we sell the stocks for 0.01. It means that we're going to put it on the books at the 0.01, and anything that we get above that sales price, we're going to put into a separate account called additional paid in capital, so that we can easily kind of see how many stocks we have out there by taking the amount on the report divided by the 0.01. We can see how many shares are outstanding. These are the amount of shares that are outstanding. So authorized 250 million shares are that we could put out there. So those are the ones that we could sell out there. Doesn't mean we have to put those out there. And the ones that are actually issued and outstanding by individuals at this point is the 92,556,295. And so if we take that at the par value times the par value, then we come up to our number that would be reported on the balance sheet in the owner's equity section.